Let's bring back our panel. Bob Bassani, Rick Santelli, watching the market action for us. Rick, let's start with you. What do you see in the 10s, 2s, and everywhere else?
2s and 10s dropped rather dramatically. 2s especially dramatically. We dropped to 393, and then it popped up to over 4%. On the 10-year note, I saw the market get very close to kind of 348, 349 area before it popped just a bit. The dollar index did the same thing. It dropped a bit. So what are we looking at in macro simple terms? We're looking at interest rates moving lower across the curve. We're looking at equities, and I'm sure Bob will get to that in a minute, not looking too badly. Everybody, of course, is monitoring what's going to happen with the next set of Fed meetings that happens in May. Are they going to do a quarter point or not? That's how it's turned so quickly. But there's nothing surprising here. Every trader I talked to was looking for 25. A few were actually looking for 50. Every trader I talked to thought stocks would be the better of it, and that all markets that they monitored, from interest rates to the currency markets with respect to outside the dollar, all these markets were going to rally, and they have been correct. And I will go on record thinking that the press conference is not going to take this away. I think the press conference, if anything, is going to accelerate these moves.
Bob, what do you make of it? We've seen a seesaw where stocks dipped lower. Now they're kind of trying to claw into these gains. Where's your attention focused?
Well, there were two options here, assuming that a 25 basis point hike was what happened, and that is what happened. So the Fed could either pause and specifically, explicitly signal that they're pausing, or they could hike and simply say the economic conditions are a little uncertain. And it seems to be the latter one, and I don't think that's necessarily a bad thing. So this phrase, additional policy firming, may be appropriate. Well, okay, they're saying maybe we'll hike in the future, but that's a much, much weaker version of their prior statements, a much weaker way of saying that we might rise. So that's certainly a bit bullish. And then the failure to really acknowledge the banking crisis is kind of striking. They said recent developments are likely to result in tighter credit conditions, but the effects are uncertain. That's a nod, but it's a pretty weak nod. So the implications here is that they are dealing with the crisis. They're still not entirely sure what the outcome is here. So I would say that this is a pause, but a very, very weak form of the pause, just enough to make the markets satisfied. The real worry for the market was what happens if they explicitly said, we're sorry, the banking crisis, we have the tools to deal with this, and we are not done fighting inflation, and we are not necessarily going to stop our interest rate hikes. That would have been a major problem. That's not what happened here, and that's why I think we're getting this modest rally right now.
David, what do you hear in the statement as we look at the famous octabox? This is my favorite thing. 8 people in one box.
It's a thing of beauty.
It's a thing of beauty. What do you make of the statement as we covet the octabox, and the fact that their prediction of core PCE or inflation is up from what it was, not down?
Well, on the inflation number, I'm not surprised by that, because our own models were saying that, inflation's coming down. It just has to come down steadily. And in fact, they were quite optimistic in December on the pace of decline of inflation. So I'm not surprised they had to mark that up a bit, but it's still coming down. It's coming down very steadily. And I just think that they're having a problem pivoting here. They really should have pivoted to a much more neutral stance. I think this is, clinging on to some hawkishness, which they're not going to be able to cling on to for very long. But it is a little bit more hawkish than I thought. But talking about, further firming rather than further changes in rates. And also, they didn't acknowledge any further progress on inflation, even though the year-over-year inflation rate has now fallen for 8 consecutive months, and wage growth is running well below inflation. They could have acknowledged that. But unless they say they're making progress against inflation, then it's getting harder and harder for them to pivot without sounding like they're scared of the banking system. So I think they missed an opportunity to go to a more neutral stance here.
Katie, do you agree?
Well, our view was that they were going to raise 25 with another 25 to come, and that they would strike this balanced statement, which I think they did. And I think it's really interesting, the focus on credit and not financial stability as being sort of the transmission mechanism of what's gone on in the last few weeks. And as we all know, credit was getting tighter before we had this recent bout of volatility. So I think the Fed is clearly focused on the direct transmission mechanism of this period of instability on growth and inflation. And again, keeping their options open. I don't think they had the ability really to raise a red flag on financial instability without undermining the confidence that has sort of slowly started to come back into the markets. So they had to strike the balance, and I think they did.